information, what you need to know in this particular section. You need to know what the process is. It starts with origination. Do not call yourself a loan officer. That means you are dating yourself and you didn't pay attention in class. You are a loan originator. That's the term or the terminology that CFPB wants us to use. You're a loan originator. I call us an information gatherer, collecting all the paperwork and getting it where it needs to be. So loan origination is where the process starts. Then it goes over to the processor. The processor doesn't approve anything. They're just basically verifying the information. And once it gets through processing, then it goes to the underwriter. That's the bank. That's who's actually making the decision. Number 1, 2, and 3 are all a part of the process. Originating, processing, and verifying. Originating, processing, and underwriting. That's a part of the process. Servicing is not a part of the process. Make sure you know that. Servicing is a result of the process if it's approved. Because remember, servicing is just taking the payments and paying the taxes and insurance. If it's never approved, it doesn't go to servicing. So originating, processing, and underwriting are a part of the process. If it's approved, it goes to servicing. If it's not approved, then it doesn't go to servicing. Now, application, URLA, Uniform Residential Loan Application, URLA. You need to know the 2 main types of applications used in the industry. Fannie Mae uses one called a Form 1003. Freddie Mac uses one called a Form 65. You need to know who Fannie uses. You need to know who Freddie uses in the industry. You need to know underwriting. There's 2 types of underwriting. Automated underwriting, done by a computer to save money, AUS, automated underwriting, and manual underwriting, the old-fashioned way with just a calculator and a pencil. You need to know the 2 main types of underwriting systems, computer systems used in the industry, and by whom. Fannie Mae uses one called DU, Desktop Underwriter. Freddie Mac uses a system called LP, Loan Prospector. You need to know who Fannie uses. You need to know who Freddie uses. Fannie Mae uses DU, Desktop Underwriter. Freddie Mac uses LP, Loan Prospector. You need to know conventional loans, and put in parentheses there conforming, because sometimes they call them conforming. Conventional conforming loans. This is what you need to know. They're not insured. Circle the word insured. And on top of insured, I want you to write FHA. So they're not insured or guaranteed. Circle the word guaranteed. And on top of guaranteed, I want you to put VA. So conventional loans are loans that are not insured, meaning they're not FHA, and they're not guaranteed, meaning they're not VA, by any government entity. The ratios for a conventional loan, 28/36. This is what people tell me, well, I've seen other ratios for conventional. And this is when I tell you to pass the test. When you get this question, the ratios for conventional are 28/36. That's what the answer is to pass the test. No matter what you've done out there in the industry, if you want to pass the test, the ratios for conventional, 28/36. PMI is required if the borrower puts less than 20% down, meaning the LTV is higher than 80%. And listen to what I'm saying here because it goes right over people's head. The late fee is 5% of the P&I only, not the PITI, not the payment. They cannot charge you a late fee on the taxes and insurance portion. So they're going to try to trick you. The late fee is 5%, but the P&I portion only. And on the test, they're going to say the principal is $500, the taxes is $300, the insurance is $200, so on and so forth. Calculate the late fee. And you'll probably remember about the 5%, but did you remember to only calculate that on the P&I, the principal and the interest? They cannot charge late fee on the taxes and insurance portion. That's why you really need to make sure you go through all my tests so that I can trick you all the different ways they're going to trick you. Got that? Now, FHA loans. Circle the word insured. FHA loans are insured. The FHA does not lend the money. They just insure a portion of the funds in case the borrower goes into default. FHA loans are insured. whenever you see the term insured, it means FHA. Down payment for FHA loan is 3.5%. And the ratios for FHA, no matter what you've seen out there in the world to pass the test, the ratios for FHA, 31/43. 31/43. They're going to ask you, what is the maximum amount that the seller can contribute on an FHA loan? 6%. The occupancy requirement for an FHA loan, the borrower must move in within the first 60 days and stay a year. On an FHA loan, they want the borrower to move in within the first 60 days and agree to stay a year. FHA loans do not have PMI. They have MIP. Again, FHA loans do not have PMI. They have MIP, mortgage insurance premium. And they also have what's called UFMIP, upfront mortgage insurance premium. You don't have to know how long it lasts and when it's going to stop. Or you don't need to know any of that for the test. Just make sure you have this straight. What kind of loans have PMI? Conventional. What kind of loans have MIP? FHA. What kind of loans have UFMIP, a one-time fee? FHA. Just keep it that simple and pass the test. No prepayment penalty. The late fee is 4% of the P&I only. 4% of the P&I only. VA loans. The term they use is guaranteed. VA loans, guaranteed. The VA does not lend the money, but what they're saying is give this veteran, this guy or this girl, a chance. Let them get into this house with no money down. And if they go into foreclosure, don't worry. We guarantee you X amount. VA loans are guaranteed. The money still comes from a bank. It comes from a VA-approved bank. VA loans are guaranteed. The maximum guarantee that any veteran can get is 25% of the purchase price or the appraised value. Make sure you know that. What is the maximum, no matter how long they've been in the service? What is the maximum guarantee that a veteran can get is 25% of the purchase price or the appraised value. VA loans have two documents that are needed for eligibility. One is a DD-214, discharge paperwork, and the other is called a COE, certificate of eligibility. The COE tells what their maximum amount that they will be qualified for. The VA only cares about one ratio, the back end. They don't have two. But the back end ratio cannot be higher than 41%. There are two names for VA appraisals. One is called a CRV, Certificate of Reasonable Value. The other is called a NOV, Notice of Value. Those are just two names for VA appraisals. Now, VA loans have what's called a non-refundable variable funding fee. Highlight that term. That term is only associated with VA loans. What kind of loan has a non-refundable variable funding fee? They don't have to make a down payment, but they have to pay a variable funding fee. Variable because it can change. You don't have to know the different amounts it can change. But you do need to know who is this fee waived for. Disabled vets, because they got hurt, and surviving spouses. For VA loan, they have to move in within the first 60 days and stay a year. Move in within the first 60 days and stay a year. They do have to have what's called residual income. So write that down. What kind of loan must have residual income? That's a requirement of a VA loan. That means they have to have some money left over to eat and live and things of that nature. So VA loans do have to have what's called residual income. The borrower must move in within the first 60 days and stay a year. The maximum that the lender can charge for their fees is 1%, and the late fee is 4% of the P&I only. 4% of the P&I only. USDA loans. People say, oh my God, we're doing loans for meat and cattle. No. A USDA loan is a type of a mortgage loan. And it's very popular here in California. Even though most people don't know about it, because we have a lot of rural land, like what used to be Paris, California, Elsinore, Hemet, all of those areas. A lot of those people got what's called USDA loans, but it could be anywhere in any state. It is another name for USDA loan or Section 502 loans. 100% financing to buy or build a property in a rural development. Rural means small towns, or also you want to put their farm communities. 100% financing. They're going to ask you, where does the money come from for a USDA loan? Because it does not come from a bank. It comes from the Department of Agriculture. No maximum loan amount, no prepayment penalty. The late fee is 4% of the P&I only. Appraisal approaches, there are 3, and you need to know when each will be used. Appraisal approaches. You have the sales comparison approach. That's the most popular approach, the everyday approach. They also call that the market approach. Don't get it wrong because they call it the market approach. Sales comparison and market is the same thing. There has to be a minimum of 3 comps. Then you have the cost approach, also called the replacement cost approach. When did they use this? Vacant land, highlight that. New construction, highlight that. Unusual or special purpose property. Let's talk about unusual. Sometimes there's some really crazy, wacky architecture, geometrical or geoside, different kind of architectural, where they can't really compare that to something else. So they will use this one if it's unusual. Or special purpose, it's a hospital, it's a school, it's a church. It's only for that one purpose. They will use this approach. Also, they call it the replacement cost approach because they use it if they are appraising something that was damaged due to a natural disaster. So say if it was burnt down because of Hurricane Katrina, or it was in an earthquake, or it was in a fire or a flood, what approach would they use? The replacement cost approach. An income approach is pretty self-explanatory. If the purpose of the property is to generate income for the borrower, it's a store, it's a laundromat, it's some kind of business, it's an auto lot, they will use the income approach. As it relates to employment, if a borrower is self-employed, they're going to want to see a minimum of 2 years tax return. This is where people tell me, but I've seen banks that have done this, that, or the other. I'm just telling you, if you want to pass the test and you get this question, and they actually, for self-employed borrower, they have to have a minimum of 2 years tax return. If they're not self-employed, they're what's called a wage earner. They get a check. They're going to want to see that they've been in the same field, the same line of work for 2 years. I did not say they had to be on the same job. I just said they had to be in the same line of work. If they're not in the same line of work, what are they going to want? Some type of certification or certificate or proof of schooling as to why they made the change. Alimony and child support are the only kind of income that are optional whether or not the borrower wants to use them. They don't have to use their child support and alimony. That's optional if they want to use it. But if they do want to use it, you have to know what law says the lender must accept it. Do you guys remember? If it's alimony or child support and the borrower wants to use it, what law says that the lender cannot refuse to take it? ECOA, because it's considered public assistance. So make sure you remember that. In alimony and child support, they have to show that it's going to continue for at least 3 years. Tax-free income, meaning public assistance income, is grossed up. Highlight that term, grossed up, and put in your notes, increased by 25%. For the test, is increased by 25%. Tax-free income, Social Security, disability, child support, alimony, they increased that by 25%. So you're going to get a question that says, John gets $1,000 a month Social Security income. How much is the underwriter going to count? $1,250. They increase it by 25%. You have to remember that. They're not going to remind you about that. Sally gets $1,000 a month child support. How much counts? $1,250. One question someone asked me, or people ask me over and over and over again, in the Facebook group, they don't understand why they keep getting it wrong. Because my question is, Danny gets paid $13.50 an hour, and he gets $500 a month alimony. What the people keep doing wrong in the Facebook group is they're not increasing the alimony by 25%, and that's why they keep getting it wrong. Do you get that? Yeah. Tax-free income must be, and you have to remember it. They're not going to remind you. It has to be increased by 25%.
The alimony child support, if you do use it, you have to show that it's continued for 3 years, or not use it at all.
They're not gonna give you credit for it unless you can prove. If the kid is 18 and not in college, they're gonna look at the award letter. It stops, so they're not gonna let them use that because it's not gonna continue. Now, rental income is reduced by 25%. So if I get $1,000 a month because I rent my room, they're only going to give me credit for $750. The other 25% is what's used for what's called vacancy factor. 4506T, what is that? A 4506T is a form that the lender uses to get a transcript of the borrower's tax return. Transcript. They will use what's called an 8821 to get a full copy of the borrower's tax return, but they use a 4506T for a transcript or a summary of the borrower's tax return. Now, in calculating the math, I'm going to give you some tips that you need to write down and remember. Okay? These are some tips that they expect that you already know when dealing with the math, so write these down. Number one tip that I'm going to give you. Always start with the gross monthly income. They are not going to remind you about that. To do any of the math, and you'll see it here in a second, you have to start with the gross monthly income. They may give it to you hourly, weekly, daily, yearly, but before you can do the math problem, you have to start with the gross monthly income, or your problem is going to be wrong. So that's my first tip. My second tip, understand the difference between bi-weekly and bi-monthly. If you don't understand the difference between getting paid bi-weekly, every other week, so there's 26 pay periods, and bi-monthly, twice a month, there's only 24 pay periods, your math problem is going to be wrong. That's tip number 2. Tip number 3, whenever they give you the sales price and the appraised value, because they're always going to give you way more than what you need for the math problem. So sometimes in the math problem, they're going to give you the sales price and the appraised value. Which one do you think you use for the problem? For the test, you're going to use whichever is lower for the math. So whenever they give you a problem, and most people don't know that, whenever they give you a problem, they give you the sales price and the appraised value, you have to use whichever is lower for the math. So those are my tips that you need to know going into the math, because they expect that you already know this. Okay, they expect that you already know this. So take out your phone or whatever you're using for a calculator, and let's do these few math problems. The first thing I'm going to show you how to calculate is what's called LTV, loan to value. Calculating LTV, loan to value. This is the formula for calculating LTV. You take the first loan amount and divide it by whatever is lower, the sales price and the appraised value. Press equal and just read what it says. I cannot tell you how many times they're still adding this and they're still adding. I'm like, what are they doing? You take the sales price, you take the first loan amount and you divide it by whatever is lower, the sales price and the appraised value. Just press equal. For the CLTV, combined loan to value, you're going to take the first loan amount and the second loan amount and divide it by whatever is lower. Press equal and just read it. For LTV, is just the first divided by whatever is lower. CLTV is the first and the second divided by whatever is lower. Here is your problem. If you have a home that has an appraised value of $120, it has a sales price of $125, The loan amount on the first is $90,000. The loan amount on the second is $10,000. Calculate the LTV and the CLTV, and I'll let you know if you're right or wrong. Take a few minutes to do that. So the LTV, you have to take the first loan amount, which is what, $90,000, and divide it by whatever is lower, 120, press equal. What did you get? 75. And for the CLTV, the 90,000 plus the 10,000 divided by whatever is lower and just press equal. So the 90,000 plus the 10,000 divided by 120,000, and you should have gotten 83% LTV. That's how you calculate LTV and CLTV. So the next one I'm going to show you is calculating ratios. How to calculate ratios. We call them the front and the back ratio, or the top and the bottom. But on the test, they call it calculating the HER. I was like, well, who is she, the HER? Housing expense ratio. You need to know that term. What do they mean when they say housing expense ratio? Well, to us, that means the front end or the top ratio. You got to take the house note, the PITI, and divide it by the gross monthly income. The PITI divided by the gross monthly income, and just press equal. For the back end, or what they call the TOR, total obligation ratio, you're going to take the PITI plus their debt. And remember, you're only going to be counting debt that's going to show up on the credit report. Not like the soccer dues or all of that stuff. Just debt that will show up on the credit report. But there's two things you have to remember about the back end. If it has 10 payments or less, if it's credit with 10 payments or less, you don't count it. Unless it's a lease. If it's a lease, I don't care if it has 1 payment or 100 payments. You have to count it every single time. So pay attention to the problem. Did it say an auto loan with 6 payments left? Or did it say an auto lease with 6 payments left? That's going to make a difference. Do you guys get that? You have to understand that. So here is your problem. Smith's annual income is $60,000. Their house note or their PITI is $1,550. Their debt is $450. Calculate the front end and the back end, and we'll see if you're right or wrong. Calculate the front end and the back end. So the first thing you had to do is calculate the gross monthly income. The gross monthly income, $60,000 divided by 12, should have been $5,000. Then you can calculate the front, which would have been $1,550 divided by the 5,000. You would have gotten 31%. And then you're going to calculate the back, which would have been the $1,550 plus the $450 divided by the 5,000. The back end would be $40,000. That's how you calculate the front end and the back end. 40%. Yeah, 40%. So now we're going to do what's called calculating maximum mortgage payment. 3 steps. Okay? Although there's probably tons of other ways to do this, if you do it this way that I'm showing you, your answer will always come out right. And someone always wants to show me a different way to do it. I don't want to know that. I just want to know the way I know. Step 1, step 2, step 3. If you do it this way, it's always going to come out right. Step number 1, also you should know there's some problems that if you have not memorized the ratios, you wouldn't be able to do them in the first place. You have to memorize the ratios. Going into the test, you need to know what the ratio is for FHA, conventional, and VA. You're supposed to know that. Okay? So this is this problem. This is how you calculate maximum mortgage payment. Step number 1, you're going to take the gross times the front ratio. In the problem, they'll tell you if it's FHA or if it's conventional, and you need to know that ratio. the gross times the front ratio. Press equal. Step number 2, the gross times the back ratio. Subtract the debt. The gross times whatever the back ratio is minus the debt. Write that number down. Step number 3 says, look at both of those numbers you just wrote down. Whichever is the lowest is the answer to the problem. And people ask me, well, how come I can't just do step 1? Well, how are you going to know what's lower if you didn't do them both? Follow instructions. Step 1 says take the gross times the front ratio. Step 2 says take the gross times the back ratio minus the debt. Step 3 says look at both of those. Whichever is the lowest is the answer for the exam. Here is your problem. A borrower has a stable monthly income of $4,000. They have debt of $600. They're getting an FHA loan. So hopefully you've memorized the ratios for FHA. Because if not, how are you going to do it? What is the maximum monthly payment that the borrower will qualify for? Go ahead and do step 1, do step 2, and do step 3. Step 1 says take the gross times the front ratio. Well, the front ratio for FHA is what? 31%. Step number 2 says take the gross times the back ratio, 43%, and minus the debt. Step number 3 says whatever number is the lowest, that's the answer to the problem. If they ask you to calculate maximum mortgage payment, this is what you do. Step 1, step 2, and step 3. This is the steps to calculating maximum mortgage payment. These are the ratios that you just have to memorize. My biggest thing when I was doing the test and studying for this is I was always confused. Am I supposed to multiply something or am I supposed to divide something? I don't know. Is this a multiplication problem or a division problem? I hate math. Which one do I do? Well, this is what I learned, and write it down here. If they're asking you to calculate a ratio, that's a division problem. If they're asking you to calculate a ratio, that's a division problem. If they're asking you to calculate a payment amount, that's always a multiplication problem. Once I learned that, then I was able to figure out, am I supposed to multiply or divide? If they say, what is the ratio for, well, that's division. What is the payment amount for it? Then that's multiplication. Got it? Now, the math part stresses a lot of people out, but just know they can't give you more than 7 math problems. That's the max. You can even miss all the 7 math problems and still get pass the test. I did a string, I think just yesterday or whatever, because my students were killing me with all the math problems. They were stressing so much on the math problems. And I had to let them know, you guys should be concentrating on regulation, this, that, and the other, and FACRA or whatever. You're going to have 25 or 30 of those. Most people get 4 math problems. That's it. But the most that they can give you is 7. If you join the Facebook group, look at the string. We asked the last few test takers, how many math problems you got? The majority was 3 or 4. How many hours did you spend studying math? Tons. For 3 or 4 problems, you should have been concentrating on some of the other areas. I'm not saying don't do the math, but I'm just saying if you're going to stress out on something, don't let it be math, let it be federal. Make sense? You're going to get 25 or 30 of those. You're going to get 4 or 5 math problems. Okay? Now, ethics. Ethics is all about right or wrong, things you should have learned in kindergarten. Be fair, tell the truth, be honest. They're going to give you scenarios. If it sounds bad, it probably is. Okay? So most people really don't have a problem with ethics because if it sounds like somebody is being cheated, they probably are being cheated. But there's some definitions that I